Calculate the value of the share from following information. Profit of the company is given 290 crore. Equity share capital is given as 1300 crore. Face value of the equity share is 40. Debt ratio of the company is 27%. Long run growth rate of the company is 8%. Beta is 0.10. Risk-free rate of return is 8.7%. Market return is 10.3%. Capital expenditure per share is 47 rupees. Depreciation per share is rupees 39. Change in the working capital is 3 rupee 45 paise. Please go through the question. Let us have understanding of this question. Everybody is requested to pay attention. I am giving explanation to you, that's how to do this new question. See, the equity share capital is given and face value is given. So 1300 crore divided by 40 rupees per share. So the number of equity shares are given as 32.5 crore. So 32.5 crore into 40. That is the way, say you have been provided with this 1300 crore information. That's okay. Nothing is great in that. Profit of the company is given 290 crore. So 290 crore divided by number of equity shares are 32.5. So the earning per share is 8.9231. So it is 8.9231 is earning per share into number of equity shares are 32.5 crore. So over here it is 32.5 into 40. So debt ratio of the company is given to us a new information 27. How to incorporate the same, I just explained that to you. Growth rate is given 8%. RF is given 8.7, RM is given 10.3 and beta is given. This information will be useful to calculate the cost of equity using CAPM. RF plus beta into RM minus RF. So RF is provided to us as 8.7. Beta is 0.10. RM minus RF. So 10.3 minus 8.7. Don't write anything. Let me explain you. 10.3 minus 8.7. 1.6 into 0.1. 0.16 plus 8.7. So it is 8.86. So see, calculation of the EPS is not something new for you. Calculation of the number of equity shares is not something new for you. Calculation of the cost of equity is also not something new for you. Now what are the new information that we have in this question? The new information is the debt ratio. New information which we have is the capital expenditure per share. New information is the change in the working capital. New information is the depreciation per share. Now whenever we have been provided with such information, listen carefully, whenever we have been provided with such information, then as per institute suggested answer, we have to make the calculation of the price of equity share using free cash flow for equity approach. Yes, this is an approach with which we are required to make the calculation of the price of equity share. Free cash flow for equity approach. How to make the calculation of the free cash flow for equity? Let us understand it. We understand that, say over here, 47 rupees is the capital expenditure that say we have to make in the business. 3 rupee 45 paise is the change in working capital. Now the word change is indicating that there may be an increase in the working capital or there may be a reduction in working capital. But generally, for a growing concern, we will assume that say this is an increase in the working capital. We understand like this. Listen carefully, let me explain you only. 47 rupees is the capital expenditure that you have to make. However, you already have the depreciation of rupees 39. So 47 minus 39, only 8 rupees of the investment to be made in the business. Why? Because 39 rupees is the kind of internal cash accrual that you will be able to generate. So 8 rupees of the capital expenditure to be made in the business plus 3 rupee 45 paise is the working capital investment to be made. So 11 rupees 45 paise is the amount of the investment which is required in the business. We have been given that the debt proportion of the company is 27%. What does it mean? It means that whatever the investment that say we require in the business, out of that 27% will be the debt financing. So 11 rupee 45 paise into 27%. So we understand that say 3.0915. This is the amount of the debt financing that we are going to have. So the remaining is going to be the equity financing. So the amount of the equity financing which we are required to make is 8.3585. So whatever the amount by which we are going to expand the business, in that there will be a proportion of the debt financing and certain proportion of equity financing. Whatever is the amount of the equity financing that you have, that you will finance out of the earning that you have in the business. That is 8.9231 minus 8.3585. So we understand that say 0.5646 is given a technical name as the free cash flow for equity. That is what it has given a name, free cash flow for equity. Now this is what we understand is of year 0. So we can make the computation of the P0 like this. Free cash flow for equity for the first year divided by K minus C. So instead of taking the dividend in the numerator, we will take the free cash flow for the equity in the numerator. We have the dividend discount model approach, we have earning capitalization method approach, and this is the third one wherein we will give importance to the cash flow for the purpose of making calculation of the price. And friends, importantly we understand that say whenever we have been provided with such information, at that time it is implied that say we are required to use the free cash flow for equity model for the purpose of calculation of the price. This is what say we understand. So please write an answer. Working note number 1. Calculation of number of equity shares. So equity share capital divided by face value per share. Equity share capital is an amount of 1300 crore and the face value is 40. So that will give us the number of equity shares, 32.5 crore. Working note number 2, calculation of earning per share. It is profit upon number of shares. The profit information is given to us 290 crore, and of course we'll assume it to be the earning available to equity shareholders. So 290 crore divided by 32.5 crore. So 8.9231 rupees per share. Working note number 3, calculation of amount of investment to be made by equity financing. Capital expenditure is provided to us in the question 47. Less depreciation it is an amount of 39. So it is 8, add increase in working capital. Change is understood to be over here increase 3 rupee 45 paise. So the total comes to 11 rupee 45 paise. Less debt proportion, it is 27%. So 11.45 into 0.27, 3.0915. The rest is the equity proportion, 73%. So 8.3585. That is the way we'll make the computation of the amount of the financing required from the equity shareholders. In my opinion, this is an important working note. Working note number 4, calculation of free cash flow for equity. It will be calculated like this. It is earning per share minus investment. Earning per share is 8.9231 minus investment is 8.3585. So 0.5646. Working note number 5, very simple. Calculation of cost of equity. RF plus beta into RM minus RF. The risk-free rate of return is 8.7. beta is 0.10, RM is 10.3, RF is 8.7. (8.7) plus 0.10 into 10.3 minus 8.7, 1.6. So 8.7 plus 0.16. So it is 8.86%. After making this calculation of price per share, in bracket I am writing free cash flow for equity method. It will be computed like this: free cash flow for equity for the first year divided by K minus C. So free cash flow for equity of year 0 into 1 plus G. So it is converted to end of year 1. Divided by cost of equity, which is 8.86%. So 0.0886 less growth rate is 0.08. Free cash flow for equity is 0.5646. Into 1.08 divided by 0.0086. That is the way the price is calculated. So 0.5646 into 1.08. So 0.6098 divided by 0.0086. 0.6098 divided by 0.0086. 70.91. That is the way we'll make the calculation of the equilibrium price. We don't have to write any conclusion or we don't have to take any decision. We just have to make the calculation of the price.